Well, moving from company results to take a look at the bond market, I'm joined now by Tertia Jacobs, tertiary economist at treasury economist at Investec Corporate and Institutional Banking. Tertia, I don't know what's happening today, but clearly I've lost my teeth. I've left them somewhere, but good to have you with us nonetheless. Let's pick up on the local bond market. It has been very interesting, but maybe from a global perspective, we've seen the dollar rally quite significantly. The US market is something that is expected to continue being the growth engine of the globe, but how long can one country keep the globe's growth going for?
You know, Gugu, I think that is one of the major questions that's being asked at the moment. However, what's driving the markets at the moment is this differentiated growth. And the reason why the dollar then has rallied relative to the euro and emerging market currencies is because of the relative strength, which is likely to lead to the US embarking from a protracted period where interest rates have been extremely low. So when you look at what's driving the currencies, it's basically interest rate differentials, and that has been supporting the dollar then also relative to the rand.
But what does this mean then for US treasuries? Are they performing well or on the opposite end?
So Gugu, against all expectations, you know, in the beginning of the year, we thought that US Treasury yields would actually end the year higher, closer to 3%. Today, the 10-year Treasury yields traded around about 2.34%, and that notwithstanding increasing signs that the US labor market is accelerating. I think what has contributed to this decline in US Treasuries against our expectations is that the Fed is going to hike interest rates. They are going to hike, but where they're likely to head, in other words, the peak of their Fed funds rate could be lower than in the past. So say, for example, is historically your Fed funds rate in periods of strong growth would increase to about 4%, right? Now the forecasts are that it could increase to a rate round about, say, 3%, which means that the increase is going to be lower. I think next year what would matter is the pace of increase. But what's contributing to the downward adjustments of neutral rates is that the global economy, the capacity, potential growth has declined. And I think one of the reasons for that is that there's not a lot of investment in the capacity of an economy, for example, fixed investment. And even the US, in the past, its growth potential was around about 3%. Now it's likely to be less. So in a way, you will need lower interest rates relative to in the past.
But that's not going to be the current situation moving forward, as you allude to, that we might see interest rates hiking in the US.
They are going to, but I think what the markets are looking at now is that the global economy, for example, yesterday the IMF came out and they also revised their growth forecast for next year lower. So yes, they expect growth to pick up next year, but the pace, the strength of the global economy is less, and that of course contributes to what kind of monetary policy stances central banks will adopt. And I think the thinking now is that no one is going to hike interest rates very aggressively in that kind of environment. So that is where the shift has come in. So to come back to your first question, America is now sort of seen as the engine of growth. China at the margin is not accelerating. They're implementing reforms, and they don't want to cut rates aggressively because that can lead to renewed credit demand when the economy is already very indebted. In the Eurozone, the economy is struggling to gain cyclical momentum. So the ECB is actually doing what they can because they cannot cut interest rates further. They want weaker euro. So from that perspective, it's all relative, and hence the dollar is strengthening under these circumstances.
But what does this mean then for emerging markets? Because we've seen our currencies weaken quite significantly on the bonds front.
You see, what it means for countries such as South Africa, we have a very large current account deficit. We import more than we export. Our exports are struggling because of our production sector that's struggling. international demand is not that robust for our exports. Yet we continue to import more than we're exporting. So we need to finance that. And because our fundamentals are not that great, not many foreign investors are currently putting new money into the economy. So that is contributing then to the rand that is weakening, combined with the dollar that's strengthening. So it means that we are in a very challenging position.
And it could get worse because interest rates will go up in developed markets next year.
Yes, yes. So then that is where relative values come in, because interest rates around the world in a way are determined by what happens to American interest rates. However, the new dynamic that has come in over the past few months is that the ECB has cut interest rates. So, for example, when you look at 10-year German bond yields, they're trading at less than 1%. So that's also, in a way, keeping a bit of a lid on American, bond yields, and that is also then spreading around the world. So everything is very integrated, but the risk for us is next year, when the Fed starts to increase interest rates, you will get a bit of an adjustment in your longer dated yields. I think the difference perhaps then is because, as we said earlier on, where short-term interest rates are heading to can be lower than where it was in the past. Okay, so instead of US Treasury yields perhaps going to, say, 4% at the end of next year, they could rather increase to, say, 3.4% or 3.2%. I'm just giving an example. So around the world, the level of interest rates appears to have declined.
Tough times ahead. Tertia, thank you so much for your time, no doubt. That was Tertia Jacobs, Treasury Economist at Investec Corporate and Institutional Banking.